I've had a lot of requests recently to provide feedback on a number of different topics. I'll try to get around to them, but in this video I'm going to address some questions and comments that I've received regarding the gold to silver ratio. I'm sure that everyone is aware of the current gold to silver ratio and that it stands at historic levels of above 110. It's natural to think that this is a bargain level for silver and a sure opportunity for profit. I'm not going to disagree that silver seems like a good value here, but I've always been of the mind that a person should consider the justifications for a purchase as well as the potential weaknesses of those justifications before making the purchase. In the end, it doesn't really matter how attractive a theory is. What matters is whether or not it worked. So here goes. I think the first thing I want to point out is that a person who chooses to buy physical silver, which many people do, is going to have a tougher time making a significant profit off of the trade than it would seem on the surface. One has to consider the spread between the cost of obtaining the physical silver and the dealer buyback price. When this is taken into account, the effective retail ratio is more like 80 to 1 than 110 to 1. A person might not like the premiums where they currently stand, but it's a reality that the metals buyer needs to consider. Another consideration is that movements to low gold to silver ratios, at least over the past 50 years, have been very quick and relatively short-lived. Let's take the spike down in 2011 as an example. Put yourself in the place of the person who accumulated silver patiently over the 1990s and 2000s with the idea of trading it all for gold when the ratio dropped to the often touted 15 to 1. 10 or 20 years can seem like an eternity, especially for a person who may only have a 40-year working career. So this person bought religiously through thick and thin, through elation and through disappointment. Then, during the aftermath of the financial crisis and the bailouts that ensued, silver starts to take off in price. The gold to silver ratio takes a rapid dip in the spring of 2011, and in the span of only a couple weeks hits a low of 32. Should our silver saver make the trade or hold on? Obviously, if 15 is the right target, holding is the right move. But how will our silver saver know? Without perfect foresight, it's not possible. But we now know with the benefit of history that holding was a bad idea. I happen to be one who made the trade in early 2011. I based my decision not upon a magic target ratio, but on what I perceived to be mass euphoria at the time. It was a lucky guess, but I will readily accept the benefits of luck. If we take an objective look at the past century, we can see that the gold to silver ratio spent very little time under 30. In fact, it really hasn't spent much time under 40. So what is a good target low that we should keep in mind when we want to sell? Some suggest that because only 9 ounces of silver currently come out of the ground for every ounce of gold, that 9 is the right answer. It sounds good on the surface, but does history suggest that simply going by the production ratio works? I've updated my data with gold and silver production statistics from the last few years. I won't go into detail regarding Hubbert Linearization here. If you'd like to know more, please watch my video titled Hubbert Linearization of Gold and Silver. I'll leave a link in the description. What is shown on the top are two graphs for both gold and silver. They are the yearly production expressed as a percentage of total cumulative production plotted against cumulative production. Generally, this is a way of evaluating the yield from extracting finite resources from the planet. Usually, production curves follow a bell-shaped pattern where production is slow at first, then technological improvements allow the rate at which the resources can be harvested to increase, and then, due to depletion, the rate of extraction declines as technology just can't keep up with how difficult it becomes to go after what's left in the earth. Plotting the data this way linearizes it and allows for inferences to be drawn. We can see that so far there have been about 6 billion ounces of gold mined throughout history and about 50 billion ounces of silver. Interesting. This would suggest that 9 to 1 might have been with us for a while, but more on that in a minute. Look at the charts on the bottom. This shows the yearly production of both gold and silver going back to 1930. Combining the information from the top graphs with those from the bottom, we can see that neither gold nor silver are really in decline. Silver has taken a bit of a dip recently, but its production also took a dip in the 1940s too. Gold has had many cycles in production as well, but when we look at the long-term information, it appears that neither gold nor silver production are showing signs of being in decline. I'd really want to see a decade more of declining production data before I was willing to say that a top was in. What's really important to notice is that both metals appear to have limits on how quickly they can be extracted from the earth to add to the above-ground inventories. The above-ground gold stock has only grown by about 2% per year for the past century. The above-ground silver stock has only grown by about 4 to 5% per year. Whoa, wait a minute, Belling P. Your chart shows 1.5%. Yes, that's true, but this is based upon cumulative production. Remember that about 2/3 of silver's production is consumed by industry each year, so the above-ground stock is probably only about 15 to 20 billion ounces. Okay, so we've taken a look at production statistics. Let's take a look at relative production and compare it to the gold to silver price ratio. In blue on this chart is the yearly silver production amount divided by the gold production amount. It is plotted against the left-hand axis. In red, I plot the yearly average gold to silver price ratio. It is plotted against the right-hand axis. I'm sticking with yearly average numbers here because I think they are more useful for long-term planning. Spikes are nice, but only if you're lucky enough to exploit them. The first thing to notice here is that for the past century, the production ratio has always been less than 9 to 1. 9 to 1 is not a new thing. Despite the ratio being below 9 to 1 for a very, very long time, the price ratio never hit a 9 to 1 level. In fact, on a yearly average basis, the lowest it got was around 20. But we can also see that short-term swings in production levels are not a good indicator of the direction in the gold to silver price ratio. Let's look at the 1950s. The production ratio climbed while the gold to silver ratio fell. Then in the 1970s, the production ratio climbed significantly, but the gold to silver price ratio only followed it up with a 10-year lag. The more you study this chart, the more you'd have to come to conclude that production ratio is really not a good metric for predicting price movements. Frankly, I think it's more likely that the movements in the gold to silver price ratio are the cause of changes in relative production ratios, but not the result of them. But there is one link between the long-term trend of price ratio and production ratio that I'd like to point out. And that is that both the production ratio as well as the price ratio have been on the rise for close to a century. Is this information useful? I think it is. I think that what it tells us is that, first, gold is becoming relatively more difficult to extract than silver. This was evident from the Hubbert Linearization chart that I showed before. It also suggests a reasonable natural current level for the gold to silver price ratio. This would suggest that it's somewhere in the range of 65. We can probably expect that the price ratio will be somewhat attracted to this level. I don't know what the exact reason is for this. It could very well be that it's a function of how relatively expensive it is to produce each metal. Maybe when the price ratio is low, it provides added incentives for the mines to mine for silver rather than gold, and vice versa. It does appear that when eyeballing this chart, that the production ratio does tend to respond to changes to the relative price. And that's the explanation that at least makes the most sense to me. So what do I think about silver's prospects going forward? I think they're pretty good, actually. A target ratio of 9 to 1? I'm thinking no. 15 to 1? I'm thinking no for that as well. A target of 50 to 1? That seems reasonable to me. Would I take advantage of it with physical silver? Probably not. Much of the upside will be chewed up in dealer premiums at this point in time. I might be tempted to play the ratio with one of the vehicles that I suggested in a video I put out last week titled Options for Those of Limited Means. There are a few pooled metals savings vehicles that can be bought for a reasonable premium. So yes, I'm bullish on silver here, but not as bullish as many of the other precious metals YouTube channels out there. Based upon years of study, I would not recommend being 100% silver. Take a portion of your metals portfolio and position it for taking advantage of the ratio, but be careful. I've had a lot of requests recently